Well, good day, traders. I trust you are all well, and welcome to Live Trading Profits. This rather interesting week of the month, week of April. First week of the month, holidays galore. Well, international holidays. I'm sure there's all other holidays in different countries, but international holidays that affect us. Hang Seng 50 closed today. We've got long holidays coming up, Friday all the way through in some places, including Monday. Then we also have this galore of news that's coming up. So we have to be ultra careful, all sorts of forces in the market. And when you're trading through the holiday season, the thing to bear in mind within your trader's equation, which is, of course, risk, reward, and probability. The issue is risk management. That's the thing that you have to manage. Risk management, capital preservation. I'm emphasizing that in particular during holiday seasons because surprise candles can be galore. There'll be plenty of them. It's like you waiting for something to set up, you're trying to structure your trade, everything is clear, and then boom, there's a huge bull candle, a huge bear candle. And you say, but hang on, did I miss a news announcement? You go check your Forex Factory or FX Street, whatever news announcement you use, and there's nothing. And you wonder what is happening. Well, that tends to happen during holidays. All sorts of strange forces, as I say, in the marketplace. The price structure will still, the price patterns will still be the price patterns. The only thing is that your stop may end up being far away. If that's the case, do not execute the trade. So if you see huge candle forming and it's outside of what you can take as a stop, don't take a stop and just chuck it in the middle. It's a recipe for disaster. What I want to talk about today is the unfolding gold story. In particular, my reason for focusing on it is because the probabilities of something likely to happen that I've been speaking about the past couple of weeks on this show, Wednesdays at the market with the guys subscribed to it as a guest in Live Trading Buddies, those probabilities have been unfolding the way that I mentioned them. Well, Jeff mentioned it if you were in the show on Monday. And I've always said that I know with the way that I trade, I am 100% right 60% of the times if I'm talking about trend trading. And I'm 100% right 40% of the times if I'm looking for reversal trades. So probabilities. We spoke about gold. I'm not going to go through everything else here. Let's go back to the previous shows and have a look at it so that I don't bore you. Gold is one of the 4 markets that I'm actively trading. I'm trading Hang Seng 50, UK 100 gold, and euro versus the yen, that currency cross. We spoke about a bull breakout, and we said as far as the bulls are concerned, they saw this, this is a monthly chart. They saw this February candle as simply a pullback. And when we were talking towards the end of March, I did point out that the list that the bulls need to do, the absolute minimum that they need to do to convince the rest of the market that, hey, the bulls are taking over, was to close above the high of February. And in doing that, of course, they close above the high of January. A little tail on the top, which was bears coming in to try and prevent them closing above the 2000 level. Now, 2000 is a huge number. It's a big round number, but also psychologically, as far as gold is concerned, gold breaking above 2000 is big news. But what does price action tell us as a higher probability event based on what we're seeing here? Now, the fact that we're looking at the monthly chart should not make a difference to the way that we interpret price action, because markets are fractal, F-R-A-C-T-A-L. I love that word. When I first heard it, I said, my goodness, this is a big word. What does it mean? But once you get to understand it, it's a huge assistant as far as price action trading is concerned. All it means is that the chart patterns you see on any time frame will repeat themselves just the same on any other time frame. So whatever we're seeing on the monthly, you can see it presenting itself before you if you are trading the 5-minute time frame, which I trade. So exactly the same thing. It just depends on how you want to trade. It can appear on the 4-hourly, hourly, really doesn't matter because it's just coded human behavior, right? Human genetics manifesting themselves. So based on price action, March was good for the bulls, giving them the momentum that has been exhibited so far in the month of April. Again, we are on the monthly time frame. What do the bulls need to follow through March? Because March was good. They've already broken above 2,000, broken above the high of March. So that's good, but it's still early days. It's very, very, very early days in April. Anything can happen. The bulls obviously are also looking to the left, just as we are looking to the left. And they're saying every time that we got up here to these levels, guess what happened? The bears just came back and then sold off for months. I think it was 2, 4, 6, 7 months of selling off, including the tail here, 8 months of just selling off. We got to the top here. They sold off, forced a doji, then we went into a trading range. So the bulls are aware that as far as the bears are concerned, this is probabilities, right? There's no 100% certainty in the market. Only 100% is you being 100% right. 60% of the time, as far as your strategy is concerned. Right now, we're talking possible trading range, possible reversals. So the probabilities drop a little bit. The bears are saying, this is quite nice. Gee, all you bulls are listening to George, leg 1, leg 2. You want to go up all the way up here. As far as we are concerned, this is a double top. Everyone can see that. As far as we are concerned, bears, we want to create a lower high here. We want to just sell off this market so that April becomes a bear candle, bear high test, decent enough candle, maybe something like this, but without the tail at the bottom, or something like that without the tail at the bottom. That's what the bears want. And if the bears manage to do that, then you can expect the reverse to occur, that there'll be follow-through selling, and then they want to break below this beautiful 1,600 number. Then we're going to go for a measured move and get all the way down here. That's into the 1,100 zone. That's what the bears are thinking. But of course, the bulls have the advantage. I mean, if you just look at this structure, look to the left. I mean, it was way back in 2020 that the bulls had such momentum. Now they've come back 3 years into it. And the bulls want to just give us a close, at the very least, in April, above 2,000. And if they can create that, even if the rest of the month stays beneath this level, the all-time high 2020 and the 2078 level, as long as they give us a bull candle above here, the tail at the bottom is small. So that would be good for the bulls as an absolute minimum. But if you're a bull and you are looking at the monthly chart and gold is the thing you want to get into for whatever reason, stock market's crashing or your own private consumer resort, it doesn't matter whatever the reason is. As far as bulls are concerned, they're saying, well, let's take out this double top, because if we take that out, even if we just get above it by a couple of bucks and we are sold back in and still have a bull candle, that is good news because we have broken above the all-time high. So you can expect going forward that the bulls want to follow through this momentum, okay, so that they get above that level. The measured, the leg 1 equals leg 2 move is just here. It's not too far off for the bulls. If you look at the size of what we got in March, so if you just look at measured move above March, they will get above that quite easily. But their initial goal is to get to the measured move of that, because they're already eyeing getting up to this level, which is highly probable, because 2,500, based on what price action does more often than not, If bulls break out above that, even though there's a high low double bottom and a pull back, they want to get up there. So if you are a bull and you're out of your trades and you trade in the monthly time frame and you want to get in, well, you can just buy there. The issue is where you put your stop. If you want to buy there, your stop is down here until we get above here and close above here, then you can tighten your stop. So same process that you'll be going through even if you had been on a lower time frame. Okay, alternatively, wait for the breakout pullback. Now, a big majority of us are trading lower time frame charts, daily, 4 hourly, 30 minutes, 5 minutes, whatever the case may be. So we gotta be thinking, hey, the probabilities are favoring the bulls, so I gotta be looking to buy. Now, we spoke about this, and this is what I just want to highlight, because when we spoke on Monday, if you go and have a look at live trading buddies, the Monday show, that little snippet that I spoke as you guessed, this candle had not fully formed. The bull candle, the bear candle is one that we're looking at. And I spoke about this pattern here. This pattern is a converging triangle pattern. It's a unique pattern. If you see the market forming that on any time frame, like on the 5-minute time frame, if I see that forming, man, I get my coffee ready and I am waiting to execute, because converging triangles have a high probability, and I'm talking very high, plus 70-80% of operating in a certain manner. The forces that create the converging triangle operate in a certain manner. And I mentioned that because of the whole bullish momentum, the probability favor the bulls. So what the bulls are waiting for is, yes, that candle was forming, that is a breakout beneath the converging triangle. They would be waiting to say, we want to buy, and when are we going to buy? We know that's the bulls thinking that there's a high probability when you break beneath the converging triangle that the market will come back into the apex. We don't know when it's going to come back into the apex. It might take a couple of days to test the low of the converging triangle height and then come back straight into the apex. And then when you get to the apex, then decide if you want to break out or pull back. Now, as it turned out, the reversal back to test the apex happened within the same day. So if you were out and you were trading and you were thinking that particular manner and you saw a bull reversal, you ought to have thought of jumping in, because it's a classic pattern. The market has come back, tested the apex and closed above it. This is a beautiful enough candle for the bulls. If you had missed all of that because you thought, hey, I'm going to just take it easy, it might be a couple of days to get it, that is perfectly fine. When you get up and you see this, it's a convergent triangle apex, you got to work through in your mind, what happened? Okay, this is what happened. It broke beneath it, came back, tested the apex classic. Then you got to put your order above there. You ought to be buying, and you can put your stop beneath the converging triangle height. That would be the ideal place to put the stop. Now, when you're taking this particular kind of trade, you're not ignoring the forces that control the converging triangle, because at the breakout above its high, if the bulls don't have the momentum to close above the day, the market may want to come back again and retest the apex and then maybe create a high-low double bottom for the bulls. So essentially, it's a reversal trade. If I saw this taking place on the 5-minute time frame, I'm not going with my full risk. I'm going with, 0.25 the third half, whatever it is that I accept as my low risk. Then I just watch that if today goes up and gives us a failed breakout candle and it's a bear candle, and my stop is down here, I got to decide, do I want to hold for a test of the apex? Do I want to hold first for a test of 2,000? Which you ought to be doing, because you've taken the trade here and your stop is down here. So a test of the 2,000, you're not going to lose money, even if it comes and closes down, and you lose a little bit, but you've gone in with a fraction of your acceptable risk, so perfectly fine. So you'll be deciding whether to hold. I would hold, wait to see if today ends up as a bull breakout or it comes back to test. If it comes back to test, and if you're not in a trade, wait to see whether you get a high, low, double bottom here. And if you do, you've got to buy as a bull because it can just go. Okay, if it fails to, if there's a failed breakout and we come back and we break beneath the 2000 level and the bears are strong, you can then decide, okay, there's a test of the apex, market seems to be going down. I'm going to get out with fraction of a loss. That's perfectly fine. I can wait for a setup. So I thought I'd take us through the gold story, but the important thing, the issue is not just about gold opportunities on the daily. The issue is about this pattern. The issue is about looking at leg one, leg two, interpreting bullish momentum, in this particular case, and deciding when to jump into trade. So I hope you found it interesting, a little bit of a slower pace than I usually want to pack things in, but I really wanted to share that because I think this pattern will repeat itself over and over again. Thank you, guys, and we will see you again next week. Marlon, thank you, sir. We'll catch up with you. And guys, we'll subscribe to Wednesdays at the Market. Next week, we are starting. I look forward to seeing you live trading in my trade room. Take care. Have a good holiday, whichever way you are celebrating. Take care, guys, and bye-bye.